and we take it on the road. We take it to chapters throughout the country. We take it to anybody that wants to listen to us talk about stock. We're going to do an abbreviated version today. Usually the program runs for a couple of hours, and it's kind of no holds barred questions being taken at any topic that you'd like us to discuss. Today we do have a set presentation, but we're going to open it up for questions at the end. So feel free to ask us questions during the presentation. We'll try to get to a few of them, and feel free to ask us questions at the end of the presentation as well. Mark and I are both very social people, so without further ado, let's get to work. We do have one more click, Mark. We do have our masks ready to go in case anybody is fearful of COVID. This is just Mark's way of trying to get me into costume. I'm absolutely, I'm sure of this. Okay, well, one more click, Mark. Go on.
I can't tell you how much we were hopeful to be in Cleveland this morning, and we can't wait for the return of face-to-face meetings and conferences because it's more fun. But we'll try to have a little bit of fun here today too. Happy to be with the Cleveland and Northeast Ohio audience.
This is an educational demonstration. We're going to talk about real stocks in real time, and we're not making any recommendations as to buy, sell, or hold. You have to be the one to do your own studies and draw your own conclusions. We will try to let you know if we own any of the stocks in any of our portfolios, but please forgive us if that particular point is skipped occasionally as we move through stock lists and make you aware of stocks that we think are interesting study candidates. We do run a program at the Mid-Michigan chapter, runs once a month on the last Tuesday of the month. We'd love to have you there. We attract 300 or 400 people to the program on a regular basis. And if you'd like to be reminded of when it is, then send an email to nkavula1@comcast.net. That's my wife. She'll add you to our guest list, and we promise we'll only remind you about the round table going on, and we'll make it clear where you can register and how you can register. If you'd like copies of today's slides, a simple email to markr@manifestinvesting.com will get you a complete copy of all the slides. We're glad to share. We're happy if you'd like to go over the stocks that we're bringing to your attention. There will be lots of lists coming up, lots of ideas for you to study in the next 3 or 4 months. Invest regularly. You've heard it all before. You know darn well that we're doing nothing more than talking about putting a set amount of money into the stock market on a regular basis. Now that regular basis might be weekly for some of you. It might be monthly, it might be quarterly, or occasionally it might even be yearly. But invest regularly in better stocks. We're going to come back to this idea time and time again. And we're going to come back to the idea that better investing, while it's always counseled you to buy and hold excellent growth companies, we seem to have forgotten the rest of that counsel because it's always been there in our literature. We do want you to buy and hold excellent growth companies, but we only want you to hold them for as long as it makes sense to do so. George Nicholson always told us that the best way to put together a portfolio that's going to make money is to follow Rule 1. And Rule 1 was always to make the portfolio better whenever you had the opportunity. And in his mind, making it better meant increasing the potential for annualized return. We also counsel you to prudently diversify. We want you to diversify, of course, by industry, but we also want you to diversify by size of company. And we'll be going into that today in a little bit of detail because we think this is a place where some investment clubs forget why we're asking you to diversify by size. Mark, why don't you take the next couple of slides?
Cool. Well, it's the home of the Rock and Roll Hall of Fame, and I couldn't resist this one. In fact, I'm going to refer to this presentation as The Song Remains the Same. Ken and I both basically have kind of the same message all the time, and that's always be out there searching for small companies to augment our portfolios. And I think that little quote there from the song, the title of the song is actually The Song Remains the Same. It was also a movie, but the importance of having those small companies in your portfolios can't be overstated. And we brought this slide a year ago in a slightly different form, but those 4 concepts up at the top can be quite challenging for many investors, but it is literally what this community thrives on. Gaining perspective, making sure that you have context for that which you're reviewing and considering taking an ownership stake in, being a good steward, being patient, waiting for an opportunity to buy the stock, a better stock at a better price. Sometimes you have to wait years. In fact, I bought a stock last year that I waited nearly 10 years to buy because it took that long to be suitably priced, and be disciplined about it. And like I said, sometimes those can be quite challenging. We also had this slide in the session from a year ago, and it's just a powerful reminder. I'm going to tell a little bit of or share a little bit of information with you as Ken and I were putting this presentation together. And chime in, Ken, when you need to defend yourself. We were talking about topics, and we were talking about, well, maybe we should talk about inflation. And we actually looked at a couple of presentations that had a whole bunch of slides, and we kind of got to the end of the slides and said to each other, yeah, he just said 12 different ways. We were sharing 12 different fun facts or principles on investing and how it affects investors, put together by George Nicholson, the founder of the modern investment club movement. We said he basically said the same thing 12 different ways, and that was, you could boil it down into 3 things. Inflation is bad for investors. PEs generally go up, PEs go down when inflation goes up. And then we agreed that no one really knows what's going on with inflation. People are arguing for deflation. There's just a whole lot of active debate. I know from my monthly expense budget, there's some inflation out there for sure, but you can go back to this slide. And if you want to talk inflation, Ken tells all these stories about having a 18% mortgage on his house and all that kind of stuff. Back in that time frame, it was a tough time frame, but it was also one of the best periods in the history of better investing, because it really demonstrated what investing regularly could do. But not only that, investing in the right kind of companies, better companies, smaller companies. And that extremely challenging period in the stock market was actually one of the best periods in the history of the stocks that were selected for Better Investing magazine. So Ken, would you like to defend yourself, or do you have anything to add to that?
Yeah, the only other thing I think that Nicholson really stressed was during times of inflation, and this was an underlying theme of his in so much of the material that he put together. But the other thing he really stressed was that no matter what was going on, if it was inflation, if it was a black swan event like COVID-19, no matter what was going on, he stressed the importance of management. And a number of the points that he made about inflation ended with the words management, management, management. He was a firm believer, as am I, of the fact that a good manager is, first of all, hard to find. But when you find somebody that's a good manager, you need to step up to the plate and work with that particular company, because you have a lot of confidence. When the management is high quality, you have a lot of confidence that the company is going to make it through whatever the challenge might happen to be at the particular time. Management, management, management.
Yeah, and the moral of the story is that no matter what we face, whether it's some kind of even military conflict or Armageddon, even the pandemic stuff, if that were to turn worse, uh, the recipe that we follow is unchanging. Buy better companies, invest regularly, and buy them at better prices. Pretty simple stuff. And one of the reasons this came up, and we'll take you through a brief conversation that we have featured during our bull sessions here over the last month or so. It basically revolves around an article that compiled a whole bunch of talking head guru advice that basically is beginning to say, in some cases, scream, run for the hills as an investor. And Ken, would you like to share a little bit on what our perspective is on this?
Well, I think our perspective basically, Mark, is that we don't buy markets. We hardly ever find ourselves investing in the entire market. In fact, we know that if your portfolio contains 40 or 50 or 60 stocks, you've probably worked on diversification rather than diversification. Peter Lynch was a strong advocate of holding a relatively few number of stocks because that's the way that you were able to, first of all, prudently diversify, but second of all, had a reasonable chance of beating the market on a regular basis. We don't invest in markets. We invest in individual companies, and we think that with our analysis tools and the things that we learn, we think that we can pick companies on a fairly regular basis, witness the rule of 5, if I have to even speak of it, but we think we can pick companies on a fairly regular basis that will do better than the market as a whole.
Well, Ken, you know how to beat the rule of 5, right?
Yeah, just don't pick the bad ones, right?
Well, just don't pick the fifth stock. Just buy
Right.
the first.
Just buy the first 4, okay.
All right, here's that indicator which caused kind of that storm and a bit of debate. And what you're looking at here is what is generally regarded as one of the more reliable predictors of long-term stock market performance. And on the red is basically the amount held in stocks by citizens. And about 8 years ago, it reached a relative high back on the right-hand side here, this red line. And we've actually surpassed that here in recent months. We'll take a look at an updated version of this. But what this is basically showing is that the 10-year stock market returns do tend to track this fairly closely. And if that's true, there's a lot of people that believe, especially those investing in markets. Don't forget what happened to the S&P 500 between 2000 and 2010. It can happen. That's basically what inspired this in this particular indicator. And you can actually find this by going to that link up at the top. And here's another look that Mark Hulbert did fairly recently, giving the update. Now it kind of inverted things a little bit differently. The allocation is in red and it's on the left-hand scale. And basically as you own more stock, that goes down on this particular illustration of the data. So the argument would be current conditions, we've actually reached the point where we're at about, many people think we're going to hit 55 here in the next few months. So 55% of total assets in US households actually being some form of stock ownership, direct and indirect. And again, the thinking being could be some real challenges for market investors. And
well, as far as markets are concerned, Mark, you can make the point that if you're investing in markets, they are resilient enough. Notice they do tend to bounce off these lows fairly quickly and move back into territory that's positive return. But again, we're not investing in markets as a whole. There are a lot of clubs and a lot of individuals that made money during the first decade of this century, even though the talking heads were telling us that it was the time of dead money, with the S&P hardly advancing anything from 2000 to 2010.
Yeah, I mean, I can certainly count myself among the fortunate. I mean, here's the peak right here, and here's what Ken is talking about. That's the lost decade right there. And many of the investment clubs that we work with in this area, many individual investors did just fine as long as they invested in, guess what, better companies at better prices, and made sure that they prudently diversified. So good stuff. Here's just a little bit more background on it. That's Mark Hulbert on the right. This is just some of the stuff that he keeps track of and tries to identify, who has been the most reliable. The previous graphs are that average investor equity allocation, but you can see that some of those are a little less predictive, at least mathematically, than others. And again, the message is, I'm not sure what all this means other than to make people skittish, and perhaps, Ken, it's a path to buying opportunities for us while we go shopping.
Absolutely, Mark. I think that as long as we maintain our focus, maintain our discipline on evaluating companies using a relatively non-biased tool, as long as we maintain our focus on doing that, I think we have the opportunity and the chance of beating the market on a fairly regular basis. I belong to a number of investment clubs, and every single one of those clubs, all 4 of them, happen to be beating the market quite handily over the last 1, 3, and 5 year periods.
Okay, and that little snippet down at the bottom, we could spend an entire hour talking about PE ratios. My only advice would be just recognize that it is one piece of the puzzle. And a lot of times the gurus on Wall Street would like to reduce it down to a PE ratio, some flavor of PE, and attempt to persuade you that that has some predictive value. Just be careful. It is just one piece of the puzzle, and it can be dangerously misleading sometimes. All right. To celebrate this, I'm going to take you back to a cover story that I wrote back in 2008 as the election approached. I basically sent an open letter to both of the candidates at the time, and was basically concerned over similar things going on back in that time frame as far as run for the hills type rhetoric and hatred of common stock, picking on Wall Street, all that kind of stuff. You can go back and read more about it. I'll just note that I've never received more reinforcing correspondence